Hello everybody, my name is Thomas and I'm joined here today with Peter. As you can see here, we are without Kathy. She's taking a much deserved vacation and currently she is cruising on the Nile. So we're all looking forward to seeing photos and seeing how her trip was here. Oftentimes at the beginning of the year, she lets us take care of business here. We've started off to a very busy start of 2026. But first of all, before we get into our new year here, we just want to say how grateful we are for all of our clients and the continued support. We hope everyone had a Merry Christmas and a great holiday season, and that everyone feels relaxed and rested over this time. But Peter, why don't you go ahead and fill us in? We've had a busy 2025 for our team personally. We got a lot done. Last year, we also just had our financial literacy course go live. So we'll be having emails going out to all of our clients and also on our website. The financial literacy course that we spent a good part of last year trying to complete is now done and it is live. So we look forward to hearing your feedback. And among other events, we had a busy 2025 year here. But why don't you walk us through here some of our highlights and lowlights and what went well here this past calendar year?
Yeah, absolutely. Thank you, Thomas.
Yeah.
It was, I think it was a lot better of a year than people were expecting. I think if you were just reading headlines last year, you would have expected the markets to be performing pretty badly, especially before and after April there with Trump's tariff tantrum, as I put it. And I think a lot of clients ended up, a bit confused for why performance was so strong. So I think it's worthwhile to step back and kind of acknowledge what drove that, because you look at all this sort of macro and geopolitical risk that Trump created, the US created through that time period, and it's fair to assume that, if you're adding these massive tariffs, they're effectively going to operate like a tax and kind of hamstring growth and whatnot. But, really, if we were to oversimplify it, there's a lot more bark than bite to those tariffs. Canada in particular is protected by CUSMA. Lots of other countries are pretty quick to negotiate, bringing their tariffs down or preventing them entirely. And then probably most importantly was the big beautiful bill. It was a massive spending bill, kind of contradictory to what he campaigned on, but it kind of smothered a lot of the pain created from the tariffs. And it's been from an America First point of view, it's been a good bludgeoning tool to get what they want out of other countries, unfortunately for the rest of us. So for the US, it's kind of benefited them in some respects. So that's kind of where we kind of left off. The S&P 500 closed up over 16%. The TSX had an incredible year driven by financials and gold. We had a lot of financials exposure and some healthy gold exposure, especially relative to our peers. So the TSX was up 28%. To highlight my point about gold doing well, TSX Venture was up over 65% last year. With the venture being, kind of some smaller, more junior gold miners and explorers that have all done exceedingly well. So that's kind of, what we've seen, in North America. If we go to Asia, we had, a fair amount of international exposure in our clients' portfolios and a fair amount of Japan exposure as well too. And Japan had an incredible year, up over 26%. And, if we look to Europe did well as well too. We had a US dollar that's kind of been weakening broadly, which has helped the Canadian dollar. If we look at the whole year, obviously there's a fair amount of volatility. So that's kind of, what we can look at for last year. Anything else that you think I should add there, Thomas?
No, that was a great overall summarization of the markets there. We remain diversified, and a lot of our clients, we've had a big exposure to the Canadian market. And me and Peter were just chatting before we came in here that now 10% of our Canadian index is now exposed to gold. Gold's gone on an incredible run. So even though you might not own any miners, any individual names, by owning the Canadian index, you have a great exposure to the sector at large. And I know now we are currently in January 2026 here. We're working on all your TFSA contributions. I'm sure you've all been emailed or called, and also with your RIFs and lifts being reset. Now we're looking at topping up RSP accounts. So right now we have some new cash that we've been allocating this year. So why don't you walk us through here in 2026? What do we currently like? I know last year was a great year for international. And with Kathy, we had a client event last year or 2 years ago now on nuclear energy, which did phenomenal as well in 2025. But where are we currently allocating funds? Now with the markets here at all-time highs, I know we've been more defensive and we've been more eager to take gains and to top up your withdrawal pots. We usually keep about 2 to 3 years of income in all of our retirees' registered accounts. So we're still building up a lot of cash, being defensive, but where are we putting that money to work for TFSA contributions and RSPs? And overall, where do you see the markets going here in 2026? And what areas are we optimistic on heading into the new year?
Yeah, I think a lot of the exposure that we had in Q3 and Q4 is probably what's going to continue to do well through most of 2026. Again, crystal ball, this is just our base case, our kind of, highest conviction, but obviously, things can change between now and the rest of the year. But I think before, I kind of answer that, if we kind of look at the makeup of this year, a lot of stuff from last year is still extending into this year. We've got the big, beautiful bill, lots of tax refunds that are kind of baked into that. So, I think there'll be over $500 billion in tax refunds coming out, kind of a large year looking historically, so that could be some more cash that needs to be allocated, whether it's in the public markets or invested directly. If we look at the data centers contributed about 1% to GDP last year. There's going to be even more spend this coming year. So there's a lot of capex, a lot of money being sloshed around that is being spent in the U.S. It's been a long time where we've seen industry kind of stripped from the U.S. and exported elsewhere. We're seeing a lot of that kind of come back to the U.S. now via these data centers and kind of some of Trump's other policies. But corporate profits are still strong. We're seeing profit margins still around 15%. And I think if we're looking at the U.S. market, I think we could see a pullback in the S&P 500, but I think most of it will be driven by the Mag 7. We're seeing a fair amount of overvaluation, broadly speaking, in the Mag 7. And there's a lot predicated on, AI becoming profitable, these data centers, executing the right way. And I think there's a lot more risk baked into all that than the market's acknowledging. And the circular revenue issues, which we won't get into, that'd be its own separate conversation and video.
Yeah.
But, it's a challenge that we see with some of these semiconductor names as well, too, and the landscape as a whole. We've seen some geopolitical issues, but I think for the most part, I'm referencing Venezuela. I think for the most part, they've been constrained, but at any point in time, we could see stuff kick off in the Middle East with Iran or Taiwan. So I think those are issues that we need to be mindful of. But, kind of looking into this year, I think a lot of what's performed well last year will again this year. And, in the last kind of 3-6 months here, we've seen a lot more breadth, a lot more names performing outside of the Mag 7. And I think that's going to be a big driver of return. But I think international will perform well again, broadly speaking, specifically Japan and Europe. But, it's important that we remain diversified and kind of stay away from some of these sectors that are overvalued.
Yeah, well, that's great, Peter. We continue to remain diversified. We have an emphasis on quality, value, dividend yielding companies that we like, and we're continuing to hold cash, remain defensive. As we know, the past couple of years, there's no shortage of news, and hopefully we might see another buying opportunity this year to put some new capital towards to work. But we remain invested into the market. We remain constructive and defensive, but also participating still as well. So those are some great comments there, Peter. And again, we always throw out the invite to, if you have any questions, please email, reach out to us, call us. We love chatting with you guys and hearing about your lives, the updates in your lives, and also just answering any questions that might come to mind. But with it just being this time of year, we're in close contact, but we look forward to hearing back from each and every one of you, and we hope you guys have a great month. Thank you.